Rezolve AI, trading under the ticker RZLV, is currently priced at $4.28, experiencing a sharp intraday drop of 8.16%, or 38 cents per share. While many might see this dip and immediately dismiss it as typical volatility for a small-cap tech name, the story beneath the surface is far more complex than just a red day on the charts. What you're witnessing isn't just noise. It's a direct reflection of a deep-seated tension between what the market expects from an AI company and the cold, hard reality of its current position. The expectation, fueled by a market hungry for anything related to artificial intelligence, is that a company like Rezolve has an easy path to growth. The reality is that its journey is fraught with challenges, including the growing specter of targeted short-selling activity that many retail investors are not yet tracking. Let's break down today's action. The stock opened at $4.36, gapping down from yesterday's close of $4.66. That initial drop already set a negative tone for the session. It attempted a brief rally to a high of $4.46, but was met with significant selling pressure, pushing it down to a low of $4.21 before finding some temporary support around its current level. This pattern, a gap down followed by a failed attempt to reclaim the previous close, is often a bearish indicator. It suggests that overnight sentiment soured and sellers were in control from the opening bell. The volume, while not extraordinarily high yet, is steady, indicating that this isn't a random, low liquidity dip, but rather a concerted move. Many investors see the AI in the name and assume it's tied to the large language models and generative platforms making headlines. However, Rezolve operates in a different part of the tech world. It focuses on creating a mobile engagement platform that can make any media, print, broadcast, or digital, interactive and shoppable. Think of pointing your phone at a TV ad or a poster and being able to instantly buy the product. This is a powerful concept, but it's a B2B sales model that requires significant corporate adoption, a much slower and less explosive growth path than a viral consumer-facing AI application. The market, however, often fails to make this distinction, lumping RZLV in with the broader AI theme and trading it on sentiment rather than fundamentals. This is where we must address the growing concern of short interest. For a stock like Rezolve, with a relatively small market capitalization of around $138 million and a 52-week range that swings wildly from just over $1 to nearly $8.50, it becomes a prime target for short sellers. These are traders who are betting that the stock price will fall. They borrow shares, sell them on the open market, and hope to buy them back later at a lower price to return to the lender, pocketing the difference. The sharp drop today, on no apparent negative news catalyst, could be a sign of mounting short pressure. One of the first things discerning investors should be doing is checking the short interest data. You can find this on financial data websites like Fintel or Ortex. Look for the short interest as a percentage of the float, the number of shares available for public trading. A percentage in the double digits is a red flag that a significant number of market participants are betting against the company. Another critical metric to watch is the borrow fee rate. This is the interest rate short sellers must pay to borrow the shares. A high or rapidly increasing borrow fee rate indicates that shares are becoming scarce, suggesting strong demand from short sellers. What's your take on the rising short interest in some of these smaller tech names? Is it smart institutional positioning or coordinated manipulation? For retail investors, it's essential to understand how to interpret this data. A coordinated short attack often involves the release of a negative research report along with heavy short selling to drive the price down and create panic. While there are no major public short reports on Rezolve at this moment, the trading pattern warrants caution. Investors can protect themselves by not using excessive margin, understanding the company's actual business model rather than trading the hype, and monitoring key metrics. Keep an eye on the days to cover, which tells you how many days of average trading volume it would take for all short sellers to buy back their shares. A high number can sometimes create the conditions for a short squeeze, where a rising stock price forces shorts to buy back shares, further fueling the rally. However, chasing these squeezes is exceptionally risky and not a sound long-term strategy. The smarter approach is to understand why the shorts are there in the first place. Their thesis might be that the company is overvalued, faces insurmountable competition, or has a flawed business model. Your job is to determine whether their argument holds water. Looking at Rezolve specifics, the lack of P/E ratio on its financial summary tells us it's not yet profitable, which is common for a growth stage tech company but also a point of vulnerability. It means the company is likely burning through cash to fund its operations and growth, and its valuation is purely based on future expectations, not current earnings. This makes it highly sensitive to changes in market sentiment and interest rates. In the current macroeconomic environment, where capital is more expensive, unprofitable tech companies are under intense scrutiny. This is the reality that clashes with the optimistic AI narrative. The company's success doesn't just depend on its technology, but also on its ability to manage its cash flow, secure major client contracts, and convince a skeptical market that it has a clear path to profitability. The company has announced partnerships and integrations in the past, aiming to embed its technology into existing apps and ecosystems. Each of these announcements provides a temporary boost to the stock, but the market is now looking for more than just potential. It wants to see tangible, recurring revenue growth. The discussions I've seen on forums and social media reflect this divide. Some retail traders are bullish on the technology's potential, viewing the current low price as a buying opportunity. Others are more skeptical, pointing to the lack of profitability and the intense competition in the mobile commerce and ad tech space. This is a healthy debate, and it highlights the central question for any potential investor. Do you believe in the long-term vision and the management's ability to execute, or do the immediate financial realities and market pressures present too great a risk? Comment below with how many shares of Rezolve AI you currently hold, if any. Looking ahead, the path for RZLV is likely to remain volatile. Potential positive catalysts would include the announcement of a major large-scale partnership with a global brand, a quarterly report showing better than expected revenue growth or a significant improvement in cash burn, or a broader market shift back toward favoring growth-oriented tech stocks. On the other hand, the risks are equally clear. A failure to secure new contracts, a broader economic downturn that causes businesses to slash their marketing and tech budgets, or continued pressure from short sellers could push the stock lower. Investors should be watching for any filings related to institutional ownership. If large funds begin to build a position, it could signal growing confidence in the company's future. Conversely, if insiders start selling shares, it could be a warning sign. In summary, the story of Rezolve AI today is a microcosm of a much larger market conflict. The initial expectation, driven by the powerful AI label, paints a picture of unlimited potential. But the reality, reflected in today's 8% drop, the company's pre-profitability status, and the looming threat of short interest, is that of a company fighting an uphill battle in a challenging market. The disconnect between the simple, exciting narrative and the complex, difficult reality is where both risk and opportunity lie. Understanding this distinction is what separates informed investing from simple speculation. The path forward for Rezolve is not guaranteed, and investors need to be prepared for continued volatility as the company works to prove that its innovative technology can translate into a sustainable and profitable business.